the way I've been describing decentralized finance is, well, decentralized finance kind of has happened already with just plain Bitcoin. Bitcoin was probably the first decentralized finance platform, right? It allowed you to send transactions, send value across this sort of decentralized network, right? There's no central party that's controlling it. But the DeFi, like what has become known as DeFi is actually, like, when you think about financial services, like sending money, like if I gave money to PSAM, like that's like the very basic primitive. I can hold money in my pocket and I can send money, and that's sort of what Bitcoin does. But what people are labeling decentralized finance is these additional financial primitives that are being built on top of these open decentralized networks. So you start getting services like lending and what was the other one? Lending or stable coins or exchange or various derivatives that are happening on top of that. And so as we were creating all these sort of financial services that are built on the primitive of just holding and exchanging value on these open networks, that's starting to become labeled as a collection, collectively, as decentralized finance. And so we're getting really basic stuff. Someone put up MakerDAO, which is interesting. It allows you to open these collateralized debt positions to basically mint these stable coins, and that algorithmically keeps those coins stable. Sometimes it works. Most of the time it works. Sometimes it doesn't. So that's one of the first ones. But there are also these derivatives that are being built on top of it. And I know PSAM and I were talking about it earlier. And what I mean by that is sort of derivative in the sort of fundamental sense of like things are growing from these core ideas. But I also mean derivatives like legitimate financial derivatives. Like people are doing things like sort of cutting up loans and fractionalizing loans and giving them out. People are doing futures and synthetic assets on top of these real assets. It's starting to get more and more esoteric, but it's also starting to become like a more complex recreation of financial instruments that people like us have really never had access to, which is really fascinating.
Yeah, I mean, I think just to add to that, like what's very exciting for me in DeFi is, to riff off Kasima's last point, before this, if you were to essentially build a peer-to-peer lending platform, what I was trying to do, right? You would have to get licenses in each country. You would have to set up like 100 people shop to do operations, to do all these back office. With DeFi, you start to put a lot of that process into code. And so it streamlines a lot of this process. So I think it's going to sound like a very kind of esoteric, big hole. Like people fall into DeFi rabbit holes, right? And you have to kind of spend some time to understand like what's there. But I think the core essence of all this is it allows you to build financial services that is so much leaner than having a banking operation, right? So there is a company, and we can dive deeper into this. There's a company that does exchange. It's called Uniswap. They secure about $4.2 billion worth of assets right now, and their core team's 11 people, right? If you look at BitCup, they have like 200 people, and they're doing, I don't know how much they're securing, but it's definitely not even 100 million, I don't think.
And Uniswap, the current version of Uniswap, I think launched less than a year ago.
Yeah.
So
it's an experimentation that's happening right now, but I think what will stay is the fact that you can streamline a lot of these back-end process. So what does that mean? That means your startup cost is cheaper. That means you can offer better, more competitive rates to your customer, in theory, right? Once the infrastructure progresses forward. And then as a fintech startup, you get global market from day one, as opposed to having to go country by country and deal with that. So I think there's a lot of opportunity in that space. It's just still very early.
And just to note that you get global access for sure, but part of that is like a bit of regulatory arbitrage you're doing as well, right? Like it exists, your service exists on this decentralized network. Like who controls it? Well, nobody. What jurisdiction is it regulated under? Who knows? And so that's definitely part of it. And that's both like a little bit scary, but also incredibly exciting. So you don't have to trust a third party, but humans still produce the logic behind this money, right? And so one of the key components to it is that all this stuff is, you can introspect all of it. It's all transparent. So basically when you use a DeFi platform, people will, like the actual bytecode of the ultimately what ends up being an executable is available on a public blockchain that you can get. But on top of that, you can hash it out, and this is what projects do. You can hash out actual code so that you prove that it matches that bytecode, and then you publish it somewhere, and then people can read your code and have confidence that those two things match. And so now you can actually see the logic that is behind those transactions, and then that's what you end up trusting, right?
It's very transparent.
Yeah.
What are some of the major DeFi platforms or networks?
Well, I think Ethereum's the sort of like the genesis of this whole thing. But you mentioned PancakeSwap, which is on Binance Smart Chain.
Yeah.
And so that whole ecosystem is growing like crazy right now.
That ecosystem is growing also because of the congestion issue. So
Right,
people can't
right.
transact on Ethereum as well. And so there are these other chains, right? Because like Binance Smart Chain is really cheap, right?
Yeah.
You can actually do transaction on it.
So transactions on Ethereum cost, especially some of these DeFi transactions, are starting to cost somewhere in the $100 to $500 per transaction, right? And so if you're dealing with like, I don't know, sort of small amounts of farming, it's you know, I don't even really use Ethereum anymore because it's sort of like this crazy game now. But Binance Smart Chain is amazing. You know, like Ethereum used to cost dollars or even cents per transaction, and now it's hundreds. You know, and Binance Smart Chain gets you back down to dollars. It's pretty amazing.
Nobody cares if you're in the States or whatever country, nobody cares your skin color, nobody cares of your social and economic income, as long as you have the asset to actually loan out or collateralize. And so it takes some of these like social human bias out of the equation, which I think is amazing. Right?
So a pool is really just a token pair. So like let's say ETH I don't know, USDT, right? That's a pair, and it's the exchange works on basically a market pair, right? It's like a market pair. They call that a pool.
You gotta ask, what's a market pair?
So a market pair is like when you go and do any kind of trading, right? So when you go trade, let's say traditional stocks, right? And usually it's like you're trading, I don't know, Tesla or SEG or something like that, right? You're like, oh, I'm really just trading the stock, but really you're trading into a pair. You're trading into either Tesla USD or you're trading like SCG THB, right? That's the actual pair you're trading in. And so it's usually two assets, but the fiat asset is usually implicit when you're trading securities. In the crypto world, you have to be explicit about it because they're trading all kinds of pairs, right? And so a pool is basically a single pair. The crazy thing they do is they have this thing where they're incentivizing people to provide liquidity into these pairs, and then they usually have one pair that is the token itself. So it's usually the root token of the chain. So like it's either Ether on Ethereum or what is it, BNB on Binance. It's sort of like Bitcoins on the Bitcoin network, right? That's like the core native token. And then it's this new money that they're creating, right? And usually that pool is the pool that's yielding the most. They basically, like Vansa said, it's all incentive driven, right? So they basically said, okay, I'm going to yield like 100 pancakes per block. I'm going to yield 90 of those pancakes into this one pool. And so people look at that and they're like, oh man, I really got to get some of those pancakes because like everything else is yielding like 20%, 40%, and you're like, oh, it's 40%. This is trash, right? I want to get 500%. And so to get 500%, you got to get in this pool. But to get into this pool, you have to own pancakes. And so to own pancakes, you got to buy it from someone. And so now you've created this like reinforcing cycle of like demand and supply around this thing, and you sort of spun up the value. People want to buy this thing that allows them to earn money on this other thing, so that pushes the demand, and then the people who have been yielding it are now supplying it out, and the protocol itself controls the inflation of that, and so now you've basically created value.
It's like We're like crazy people.
I know, I sound like a crazy person.
Video game and like.
It's a money video game, yeah. That's
And
what my
it
wife calls
sounds-
what I do now.
And there's an automatic suspicion. I mean, if I really
Oh, yeah.
distance myself, it's like,
Yep.
is this some Ponzi scheme? I guess we say. So it just seems really freaky.
It's not sustainable, and like
Yeah?
people know it.
Okay.
That's the thing. But
Ah.
the interesting thing is, it's an experiment. It's part of the system growing up.
Huh.
But people realize, like with farming, people know, right? Like you're going to move to the next farm.
Do they know?
Most people that I've been talking to know that. But if you're getting 1,000% return and you know you can get in and out
Yeah.
in that time, right?
It's just speculation,
Incentive.
right? At the
Yeah.
heart of it is
There
speculation.
are a lot of technology that does, technologies are actually being born out of this, but part of this is an experiment,
Yeah.
right? And so it's experiment of what is the incentive to get people to provide me liquidity? Because liquidity is so hard to get on blockchain networks.
Interesting.
It's true. You sort of have to monitor it all the time. But you're right to be suspicious, because I think the way I describe it to people is, at best, it incentivizes certain behavior, and then at worst, it's totally a Ponzi scheme.
Yeah.
You have to get in before everyone else, and you have to get out before the whole thing crashes down, and that happens constantly. But it is like, there is interesting sort of incentive models that are being built. The actual behavior that incentivizes actually provides some value into the crypto space, actually a lot of value in the crypto space. Uniswap, PancakeSwap are actually really critical to the ecosystem as we build all these other protocols and we run all these new incentive models on top. Being able to exchange value is so important. And so sort of getting incentives for people to bootstrap that value is critical to having the whole system sort of function and be liquid and all that stuff. But yeah, it's not going to last forever. and the thing that I would say, and I think this might be somewhat controversial, is the 1,000% yields get people in the system, you know? And of course, like, okay, some people do get burned by coming in and being too greedy early on, and so they'll maybe hop from thing to thing, they might get scammed out. But if you're sort of like not too greedy about it, do your homework, and are attracted by these yields, I think it's growing the pie. And ultimately, it's like other sort of base economics, right? Inflation really only happens when the core productivity of the economy doesn't match with the growth in the monetary supply, right? And so like, if real money is sort of coming into the system, if real usage is coming into the system, like you're just measuring that with the growth of sort of like the market cap and these new tokens, right? So from an outside sort of macro perspective, as long as there's utility being created, I think it's okay. But it's definitely still the wild, wild west right now. It's still crazy, and there are a lot of scams out there, and people do jump from farm to farm and all that stuff. So when I worked at GitHub, it was like a high growth company. Like we had the classic hockey stick, like crazy year over year, you know, 200, 300%, whatever, both in users and revenue. Like it was nuts there, and we would be like, this is insane. But like I was saying, PancakeSwap, like I think PancakeSwap is like a few $1 billion total value locked in like a few months. I was in a project on BSC that I watched go from like $100 million to like $1.6 billion in 2 weeks. You know, it's like the growth of these platforms are amazing. I think it's worth asking why it's able to grow this much. Do you have thoughts about that, Vansa?
I think the question is like how long do they sustain that growth, right? If they're popping up, is it one of those things where we talked about yield farming? Is it growing because people are hopping around and that's their time? There's that, and then there's actual growth, right? If projects are actually able to sustain that market cap. So
Yeah.
I don't know. I don't know about.
Yeah, I mean, some of them, obviously, yeah, some of them are sort of flash in the pan, but some of them are definitely holding. So like, the thing I'm talking about is actually on BSC. I don't know if have you heard of AutoFarm? AutoFarm is crazy. So AutoFarm is one of these auto compounding services so this is like a derivative, right? So people have all these farming services, but like it does this yield and this other token, but it would make sense for you to compound in, and so then people build something on top, and they're like, okay, why don't we do a system where it auto compounds for you every time someone uses the system? So I saw that thing sort of peak out to 1.6 billion and then come back down to maybe like 7 or 800 million, and it's sort of just holding there. And so I think the systems that have real value, I think they definitely hold. But yeah, the evolutionary cycles of this thing is so crazy. You know, I actually was talking to Gerhard, so he was our security engineer, and he had this really interesting perspective about the growth and even some of the crashes that come out of the system. He sort of takes a security perspective on it, and maybe it's not worth touching on it, but he's saying that, you know, because these systems are able to grow so quickly and also they get hacked and they fail so quickly, the iteration cycles in the industry are the fastest we've ever seen in any technology, right? It's like $0 to $1 billion, and then you have some fault, and then, you know, it goes back down to 0, and then the money moves somewhere else, and then, you know, people start over, and that can happen within the span of like a month, you know, versus like, okay, let's set up a company, let's build a project, let's manage our treasury, let's raise some funds, let's set up a runway. These projects don't work like that. They're like in and out, you know. They're like either we set it up and it runs like mad and it keeps running, or it crashes out within a month. And then someone takes the wreckage of that company or the wreckage of that idea, or the wreckage of that code, and they do something new. They're like, oh, this wasn't quite right. Maybe we can modify this. Another team picks it up, makes their modifications, redeploys it. Let's see what happens.
Yeah, I think it's worth touching on the idea of like Lego money or composability in DeFi space. So like going back to earlier when we were talking about like low startup costs, right? This is also part of it because everything's open source, and so you can actually take other people's code, and this is why you have so many yield farms too, right? You take other people's code, you deploy it, you do some tweak, you know, whatever didn't work for them, you can actually experimenting with some other ways of doing it. And so I think that's why the rate of the innovation is happening so quickly, because the cost of getting something started is so low. Right? In fintech, that would never happen. You would have to spend like $5-6 million to essentially get started and go to market. I have an unpopular opinion, so I don't know if I should save that before.
I'll start with OmiseGo was a much greener way to send value with the same kind of trust characteristics than it was on Ethereum, and that was one thing that I was proud of, and one thing that we were able to do. What's your unpopular opinion?
My unpopular opinion is I think Bitcoin becomes kind of a controversial discussion when you talk about energy usage. But if you really compare side by side, right, Bitcoin's meant to rival essentially banking systems around the world, global banking system. If you aggregate the energy use at global banking system level and then compare it for me, you know, point me to a better Bitcoin system with the same level of trust and security, and I will use it. But today, just no one has been able to point me to that system. So I think that's my, yeah.
I mean, like, you can compare it to gold, right? Like, so gold is a $9 trillion market. Bitcoin's now a $1 trillion market. How much energy, you know, so environmental destruction, or like the aggregate of all the energy to support that market, how does that compare to Bitcoin? I actually should probably look this number up, but that's like,
actually been interesting.
yeah.
I haven't seen that.
Is it, you know, a ninth? Or is it 9 times, you know? But I think my opinion on that was, I mean, I agree with you, but my opinion on that is also like, these things are changing very quickly. So Ethereum recently just made the push to switch to proof of stake, which is a much more energy efficient consensus mechanism. Sort of getting a little bit into the technicalities of it. So Bitcoin is secured with something called proof of work, which is basically secured by energy. These new consensus systems is basically how we govern a decentralized network, is with these what they call consensus protocols. He's using something new called proof of stake, and that's basically secured by capital. So
Secured by what?
Capital, money. You know, we're basically running a money game on top of these decentralized networks to try to get people to do the right thing. So that's sort of like the next evolution in what we're trying to do. So I think that like Vansa's point is valid, but also I think everyone's concerned about it and trying to push it to be better.
My understanding is even the technologies, at a technology level, there are things being tweaked and optimized too, right? To
Absolutely.
reduce energy consumption.
Yeah, yeah. And actually, one of the things that's interesting that's happening in Bitcoin as well is there's layer 2 scaling on Bitcoin. So what we called ourselves was a layer 2 scaling for Ethereum, but there are layer 2 scaling systems on Bitcoin, and they're starting to get traction, and those are also lower in energy consumption. So there's a system called Lightning Network, and I can send you value Bitcoins on the Lightning Network that you can always withdraw against Bitcoin at some point. But our transactions between us are lower cost, faster, and much more energy efficient.
So this might be semi-philosophical mixed with technical, but in your mind, is it necessary to burn that much energy to make these things work in the long term? Maybe
not in the long term, but Bitcoin solved a computer science problem that had never been solved before. Bitcoin was a fundamental invention. We were never able to coordinate these systems before this protocol. Are you guys? I mean, there might be some computer scientists in the room, but before Bitcoin, there was this problem called the Byzantine generals problem. It's basically saying that you can't. The TLDR of that is without a central party, you can't agree on a message, right? And Bitcoin invented a protocol that solved the Byzantine generals problem. And so proof of work was how it did it, and I think it was necessary to do it at the time because you couldn't secure it with capital because there just wasn't capital in the world. There was just energy. But now I think, now that there's capital in crypto, I think we have the option to try to move the fundamental security model from energy to capital. But it had to happen. I can't see another way that we could have gotten here. But in the future, I really do hope that it gets significantly more energy efficient.